Welcome to the Deep Dive. Today we're looking into the Q2 2025 earnings call for Spruce Power. That's ticker SPRU. The call was back on August 11th.
Right.
And if you're following the energy space, residential solar installers, they're having a really tough time. Rates are up, policy issues, customer acquisition costs are just brutal.
Absolutely. But Spruce Power is trying to chart a different course here.
Yeah. They claim to be different.
And that's really the heart of what we're digging into. Because Spruce, well, they're presenting this classic microcap paradox, really strong operational performance, solid numbers, and yet the market, pretty skeptical. The stock actually traded down after the call.
So our mission today is to look past that immediate market reaction, right, and see if this different model they have, not being a traditional installer, if it's actually working.
Exactly. Are they successfully navigating this mess in residential solar? Are they building a scaled, safer operation? And crucially, that path to positive free cash flow, management keeps hammering that point. We need to scrutinize it.
Okay, let's start with the headline results, because honestly, they're pretty eye-popping. Revenue. $33.2 million.
Yeah, big number.
That's up 48% year over year.
Yeah.
And it crushed the estimates. People were thinking maybe $23 million.
Yeah, the top line was strong, definitely boosted by an acquisition they did. But for an asset owner like Spruce, you really want to look at the internal efficiency, the cash generation from the assets.
So operating EBITDA, that's their main metric.
That's the one they focus on, yeah. It's non-GAAP. Came in at $24.6 million.
Which is huge growth, 71% year over year. Up from about $14.4 million.
71%. It shows they're squeezing more cash out of the systems they own.
Okay, so why focus on that instead of, the standard GAAP net income?
Yeah.
Because that was still negative.
Right, good question. For a company like Spruce that owns, 85,000 solar systems, depreciation and amortization are massive non-cash charges on the GAAP statement. Always are. Operating EBITDA strips all that out. It gives you a much clearer view of the actual cash coming in from the operations from those assets. So yeah, the GAAP EPS was still negative 17 cents, better than last year, but still red ink.
But wait, even with those great operational numbers, the stock sold off, down about 6.5% after hours, closed the next day down 6%. It just doesn't quite add up.
It really doesn't on the surface. It's that microcap paradox in action. The market, or the type, just ignored the operational improvements, the EBITDA beat.
And just fixated on the GAAP loss.
Pretty much. When you have a small cap company still showing a GAAP loss, even if there's solid cash flow underneath, the immediate reaction is often fear. Fear about liquidity, fear that maybe they can't actually convert that EBITDA to real free cash flow fast enough. The fear they'll need to raise more money.
All right, let's unpack the operations then. How did they get that 71% EBITDA jump? Because it seems like cost control is a huge part of the story this quarter.
Oh, absolutely huge. Core operating expenses, that's your SG&A plus O&M came in at $17.2 million. That's down 19% from last year, 19%.
And the O&M piece, the operations and maintenance, that was dramatic.
Stunning, really. O&M expense was just $2.1 million. That is a 52% drop year over year.
Wow. How do you cut O&M in half?
It wasn't just, trimming fat. They talked about fundamentally changing how they service the systems. Big investments in technology, using AI diagnostics, moving away from just reactively rolling a truck every time there's a blip.
So predictive maintenance. Fewer truck rolls, as they say.
Exactly. Truck rolls are incredibly expensive. That's your biggest variable cost in O&M usually. So fewer of those, better route planning, better inventory management, new vendor strategies. It all adds up.
And it signals real, sustainable operating leverage, you think, not just a one-off cleanup.
That's what they're arguing. And it sounds plausible. They attribute it to new tech platforms, centralized service models. These things should scale. As they add more assets, the fixed costs get spread thinner, driving that per system O&M cost down further.
But is a 52% cut sustainable? I mean, the market seems to doubt they can keep that up.
That's the prove it story now, isn't it? Q3 results will be absolutely critical to watch on that front. If they hold those O&M gains, it validates the tech and strategy shift.
Okay, so operationally getting leaner, what about the balance sheet? How are they positioned financially, especially with interest rates where they are?
Looking pretty solid, actually. They finished Q2 with $90.5 million in cash.
$90 million, okay.
Which works out to over $5 a share in cash. That's a nice cushion, good dry powder for more acquisitions if they find the right deals.
And the debt. That's always the worry with asset owners.
Total non-recourse project debt is about $717 million. The key thing is the blended interest rate, 6.1%. And crucially, they emphasize that most of their floating rate exposure is hedged, materially hedged with interest rate swaps that go out like into the early 2030s.
So they've locked in lower rates for a long time. That's a big de-risking move.
A huge safety measure in this environment, yeah.
Huh.
It protects their cash flow from rate hikes.
And connecting all this, the cost cuts, the solid balance sheet, it all points back to that one main goal, right?
Positive, free, cash, flow. The CEO practically lives and breathes it on these calls. Laser focused was the phrase used.
Right.
They actually said they would have generated positive cash from operations this quarter if it weren't for some one-time non-operational items. So they feel they're right on the cusp. Every decision seems filtered through that FCF lens.
Okay, so this focus on owning and efficiently managing assets brings us to the big strategic difference. They are not an installer. How does that set them apart from all the solar companies struggling right now?
It's night and day, really. Think of the typical installer. They're stuck on what some call the origination treadmill, constantly spending huge amounts to find new customers, dealing with complex installations, permits, and shifting subsidies and tax credits. It's a tough, capital-intensive business.
And Spruce.
Spruce is more like the landlord. They buy the houses after they're built. They own about 85,000 systems, and they service another 60,000 for other owners. They step in after the installation is done, usually after the initial tax credit benefit has been claimed by someone else.
Ah, okay. So they let others handle the messy, expensive upfront part.
Exactly. And that structural difference is critical. Remember that HR1 tax bill that messed with some residential solar credits recently?
Yeah.
Management basically shrugged, said it would have minimal impact on them. Why? Because their model doesn't depend on originating new systems and capturing those specific, often volatile tax credits. They're kind of insulated from that policy risk that's hitting installers so hard.
That's a pretty significant moat then. They can potentially benefit from the instability elsewhere.
That seems to be the strategy. As legacy installers struggle, maybe Spruce can acquire their existing portfolios, their contracted assets, at attractive prices, and the potential market is just enormous.
They mentioned the scale, right?
Over 5 million residential solar systems already installed in the U.S. Spruce is still, relatively small in that context. Even if new installations slow down because of rates, there's a massive pool of existing assets they can target for growth through acquisition or partnerships.
Okay, let's break down their growth strategy. They talked about 3 pillars. Pillar 1 was M&A, which drove the Q2 beat.
Right, opportunistic M&A. That big Q2 revenue number was largely thanks to buying the NJR Clean Energy Ventures portfolio last November, added about 9,800 systems. But management was clear. They're disciplined, only looking at deals with double-digit IRRs. Not just buying growth for growth's sake. It has to be accretive cash flow.
Got it. And pillars 2 and 3 seem focused on more predictable, repeatable growth?
Yeah, exactly. Pillar 2 is programmatic offtake. This means setting up ongoing deals with partners, think home builders, or maybe other originators, shifting to a capital-light model where Spruce agrees to buy or service the systems those partners install.
So a steady pipeline of new assets without the origination headache.
Pretty much. De-risked assets coming in at pre-agreed terms, and Pillar 3 is Spruce PRO servicing.
Right, leveraging their own platform to service systems for others.
Yes, it's basically monetizing their operational expertise. They manage billing, maintenance, customer service for large third-party asset owners. The ADT deal is their flagship example, but they mention winning new deals too, like a full-scope contract in San Diego. And the beauty of this is it's capital light.
No debt needed, just service contracts. High margin potential.
Pure, unlevered growth potential. Very attractive.
There was also specific detail from that NJR acquisition you mentioned earlier, something about SRECs. That adds to the cash flow stability story.
Oh yeah, that was important. Good catch. That NJR portfolio came with valuable New Jersey solar renewable energy certificates, SRECs. Spruce locked in a multi-year forward contract to sell these.
Okay.
And they expect it to generate around $10 million in fully hedged revenue through 2029.
Fully hedged, meaning guaranteed income.
Guaranteed cash flow, basically. Regardless of what happens to SREC market prices, it makes their future cash projections much more reliable, much more bankable. It really de-risks a chunk of their revenue.
And one last signal from management. They kept buying back stock.
They did. Bought back another $1 million worth in Q2. They still have $42 million left on their $50 million authorization.
Which, for a small, thinly traded stock,
can be a powerful signal. It tells you management thinks the shares are undervalued right now relative to the cash they expect to generate. It shows confidence. Definitely something to watch the pace of those buybacks along with the Q3 results in mid-November. Those are your near-term catalysts.
All right. And this brings us to that part of the deep dive where we absolutely have to say, this is for informational purposes only. We're definitely not providing investment advice.
Definitely not. But you look at the picture, strong operational results, that huge O&M cost cut, the hedged SREC revenue. And then you see the stock reaction, totally driven by microcap fears and GAAP losses.
It screams disconnect.
It really suggests a potential valuation disconnect, yeah. The market might be missing the successful pivot here.
So lay it on us. What's the outrageous but plausible trade idea stemming from this call?
Okay, adopting the hedge fund pitch tone here. The thesis is straightforward. Spruce's shift to a stable, contracted owner-operator model is structurally sound and working. The cost controls are real. The cash flow is becoming more predictable, especially with things like the SREC contract. The Q2 sell-off, that's your entry point before the market wakes up. So the trade idea is a relative value play. You go along SPRU, you're betting on that continued conversion to positive free cash flow, you're betting on disciplined execution, and eventually a re-rating of the multiple as the market recognizes the stable, utility-like nature of these contracted assets.
And you hedge it. How?
You hedge it by going short a comparable small-cap solar installer. Find one that's still heavily reliant on new system origination, maybe thinly capitalized, facing those headwinds from interest rates and policy changes head on. That's your hedge against sector-wide issues.
So long, stable asset owner, short, risky originator.
Precisely. The catalyst for the trade to work is Spruce delivering on that free cash flow promise in Q3, showing those O&M savings are sticky, and continuing to deploy that share buyback aggressively. That combination could force the market to reassess.
It's a compelling narrative, built on that fundamental shift away from the insulation chaos towards, stable asset management. So, to wrap it up, Spruce Power delivered strong Q2 growth in revenue and especially operating EBITDA.
Driven by that NJR acquisition and critically, that really impressive cost discipline.
And they're making the case that their owner-operator model provides a structural advantage, a sort of hedge against the turmoil hitting the traditional installers.
Yeah, and that leads to the final thought, maybe a provocative one for you to consider. We see utility rates climbing, we see grid instability, huge spikes in power demand projected across the U.S.
Right.
So what's the real long-term value of a company that can successfully, sustainably acquire and manage contracted distributed power assets, basically power as a service for homeowners, while minimizing all the risks that are crushing its peers? Figuring out that ultimate value as they prove out the free cash flow generation. That's the big question for investors here.
Something to definitely mull over. Thanks for diving deep with us today.